Thank you for joining today's webcast on federal and state legislation impacting public pensions. My name is Hank Kim, and I'm the Executive Director and Counsel for the National Conference on Public Employee Retirement Systems. Today's program is part of our Center for Online Learning, which provides remote, continuing education to public pension trustees, staff, and other fiduciaries and stakeholders. Today, we will review federal and state legislation from 2019 and the state of pension policy at the end of last year. Then we will shift our focus and preview legislation and issues that we're keeping an eye on for 2020. Joining me today are our regular contributors, Bridget Early, Executive Director of the National Public Pension Coalition, and Anthony Roda, partner at the law and lobbying firm of Williams Jensen. Welcome to the both of you. Thank you. Today's format will be a moderated conversation with our two panelists. We will reserve the last part of the program for our questions. Please submit them by using the GoToMeetings portal. We have a lot to cover, so let's get right to it. So as both of you know, and as our audience member knows, January 26th through the 28th is our legislative conference, our annual program. And this is an effort to sort of whet the appetite and give folks a preview of what they might be able to expect. Before we do that, Tony, can you give us a little bit of an update or a review of where things left off here in Washington, D.C. relative to public pension legislation and policy?
Sure, Hank, absolutely. And it's good to be here again with everybody. Bridget, Happy New Year to everyone out there. You know, 2019 was a year of fits and starts on the legislative side in Congress, and a lot of that was kind of punctuated with President Trump and a lot of controversy. But we kept telling people throughout the year, you know, there could be, and really should be, because the ingredients were there, of some year-end package that could carry a lot of changes to retirement and pension policy. So we did keep our eye on the ball throughout, and there were significant changes made, enactment of the Secure Act, and then one provision that was included in the Coal Miners Health and Benefit Protection Act also affects state and local plans. So we'll talk about that in kind of more detail in a few minutes. And also we saw in 2019 the introduction of some new legislation that could benefit public employees. And I'll get into those three, some on Social Security, one health care item, and then another tax law change.
Great, we look forward to that. Bridget, how would you characterize the activity at the state level in 2019?
Overall, we had a pretty positive year. Fewer proactive attacks, which were always good to see that we are more actively engaged in conversations in the different state capitals. We also saw some legislation either pass or move that will provide relief to our retirees who have suffered from lack of COLAs due to formulas changing over the course of the last several years. So, for instance, New Hampshire passed a COLA for their retirees, which was great to provide that relief for them. You know, I'll talk about a little bit more in depth, of course, of one of our favorite states, Kentucky, which enacted some legislation towards the end of the year that, towards the end of their legislative session that really focuses on brings to light the broader problem that I think mid-career professionals see and are attracted to public service and what can happen when their benefits are possibly cut.
Okay, great. All right, so we'll discuss those in detail momentarily. So going back to you, Tony, you mentioned Secure Act, you mentioned Taft-Hartley relief legislation, and some other introduced legislation. So could you talk a little bit in detail about those?
I'll start with the Secure Act. The Secure Act was kind of in the making in Congress for, I would say, 4 to 5 years. And it was the Secure Act in the House, and it was RESA in the Senate, the Retirement Enhancement and Savings Act. A great deal of overlap between the two. One of the key provisions of the Secure Act, which is now law, is a change to the age trigger for required minimum distributions. And these are this new rule will affect 401A qualified plans. They will affect DC plans. So the new rule is if you turn 70 1/2 after the end of 2019, so beginning with January 1 of 2020, you now have a new age trigger before you need to start taking those required minimum distributions, and that age trigger is 72. If you turn 70 1/2 prior to the end of 2019, you are still under the 70 1/2 rule. So that's going to be an important change. I will highlight one other at this point, and that is, and this was a change that is required to pay for part of the changes that were made elsewhere in the Secure Act, and it deals with inherited IRAs or other account-based plans. And what the new rule says is when you are a non-spouse, and with some exceptions, and you've inherited an IRA or another account-based plan, you now have 10 years with which to take all of the distributions. No longer can you stretch your distributions out over your own lifetime. This is an important change for public plans. There is a fairly generous grandfather rule, so that it does not trigger for public plans. It will trigger only for those who die after December 31st, 2021. So that is a period of time and a fairly generous grandfather for state and local plans. And there are exceptions to this 10-year requirement for surviving spouses, non-majority age children, children who are not able, because of a chronic illness or disability, to care for themselves. So those are two big provisions that we should all be aware of.
Okay. And we'll get more details from you momentarily, but Bridget, so you in your introduction talked about New Hampshire and Kentucky, so give us some details.
So this year, the reign of terror in Kentucky has ended. Governor Bevin is no longer the governor, but before he left, had spent a lot of his term, if not all of it, really harping on public pensions and trying to drive through plan design changes that were not beneficial to the state system, let alone the state employees. At the beginning of last session, I think we really anticipated additional changes trying to be made to TRS because their bill had been struck down at the end of 2018. That did not come to fruition. Instead, what had happened is that quasi-state agencies that are part of KRS non-hazardous were going to realize a payment bump, which was going to cost upwards of 70% more of what they were accustomed to for the prior year, and was going to create some budget constraints. So the solution that ended up being passed is these quasi-state agencies are going to be able to choose to either stay in KRS and have to make the bigger payment, or they can leave KRS and have that payment, whatever the rest of the unfunded liability, amortized over 30 years. Okay. Leaving KRS means, though, that employees, not just new employees, but current employees who were hired prior to May of 2014, would also lose their current retirement benefit. So they could get bumped into a new sort of hybrid system. And what we heard come out of that is a lot of mid-level, mid-career employees who left the private sector to come over to the public sector because of the retirement security that was going to provide, really highlighting, again, the disparity between retirement in both sectors. And then the other concern being, does this create a legal challenge or a legal precedent where if you're not vested, can you lose your retirement benefits? Whereas I think we've seen, for instance, in Illinois is a big example of your pension is a promise, so you cannot take things away from a current employee. I think this new law tries to thread the needle of, yes, you were promised that pension, but you hadn't earned it yet, so let's see if we can roll it back.
Okay. And is there any thought on what these quasi-governmental entities will do?
It's very hard to, I think, surmise what they may do, but the choices that they're being forced to make are either figure out your budget so current employees can make sure they have, a safe retirement, which means do you cut staff, do you cut services, or vice versa? Do you try to preserve your budget and staffing, and these other folks lose out?
And what's the time frame for that decision making, do you know?
So the law doesn't go into effect until this summer.
Okay.
So I think until it goes into effect and someone's impacted, and those agencies make those decisions, we'll know more.
Okay. So going back to you, Tony, anything else with Secure that we should be aware of, or with the multi-employer?
Sure, there are a couple of other items I think that are worth mentioning. One is a change to the qualification rules that basically are key to all of our plans. This is regarding in-service distribution, so kind of retire-in-place distributions. And the previous rule on under 401A36, which is the qualification statutory site, was you could not have an in-service distribution prior to age 62. That rule was, carried forward in various other regulations that we've worked on over the years, including the normal retirement age regulation. Congress has now changed that to say you can actually have it now in service distributions beginning at age 59 and a half. So that is a big change, and plans are going to have to look at whether they want to offer that. It is permissive, it is not required, so it'll be a decision that the plans are going to have to make in conjunction with the plan sponsors. Also, not part of Secure, but was very important, was a repeal of the high-cost excise tax on employer-provided health care plans. Some have used the words Cadillac tax to describe that. A very unpopular provision that was part of the Affordable Care Act and always targeted for repeal, never allowed to take effect. Congress had pushed back the effective date of this tax 3 or 4 times, and finally, at the end of the year, did away with it completely. So there is no longer any potential 40% excise tax hanging out over our healthcare plans. The other thing I'll mention is those plans who are going to look at the new provisions and make changes, and some of these changes are going to be required in their plan documents, have another generous, I think, effective date to do that. So I'm going to read these words because they're always so strange, but for plan amendments for governmental plans for the new tax law, the rule is on or before the last day of the first plan year, beginning on or after January 1, 2024, or at some later day prescribed by the Secretary of the Treasury. So as you can see, and Hank and I have been in many meetings with regulators over the years and with Congress stressing the point, our plans, they just don't have a meeting and change their plan documents. These plans are embedded in statutes and municipal ordinances. This requires elected officials to come together. So one thing I'm really glad to see is that Congress in this instance has recognized the fact that our plans are different and that they require a lot more lead time in which to make the changes to the actual plan documents or statutes in our case.
Anything else you want to review in 2019 at the state level, Bridget?
No, I think the 2019 sort of feeds well into the 2020
conversation,
let's right?
Go right in then. What do we have to look forward to in 2020 at the state level?
So I think one of the things that's been really great about what we've been able to do over the last couple of years is talk about COLAs in a way that I think really connect with the legislators and the broader communities. In New Hampshire last year, again, as I mentioned earlier, if you have been out of the system for over 5 years, you will see a cost of living adjustment this year. in Oklahoma, we left it at the end of last year with 2 bills, a 4% and a 2% COLA going out for legislative analysis. We had an interim hearing in October where the systems participated and talked about that this is that they're in pretty good shape and that this would be something they'd be able to I don't want to say afford, but it's not going to all of a sudden devastate the systems, which is helpful to also have that participation. In Wyoming is another state where we're hoping to capture the conversation we started last year to get something introduced again, as well as moved further down the line. And then Kansas, Kansas is a huge state because they have not seen a cost of living adjustment in over 2 decades. Wow. And so, we hear regularly from retirees of the decisions that have to be made when you're on a fixed income, and if you're in that bubble of public employees that also don't receive Social Security, what this looks like in reality. And so we have tried to be very mindful in our conversations of both. How do we do both? How do we award a COLA and maintain or preserve the funding status of these systems? Because we don't want to obviously push anything that could drive plan design changes down the road. And I think all those conversations have really gone well.
Great.
Yep.
Great. Tony, so what are the things we should be looking forward to in 2020 here in DC?
Well, now that we have the Secure Act behind us, and I would also put RISA into that category because of the overlap between the 2 bills, we can start to look at the next generation of retirement and pension law changes. And the 2 senators who are taking the lead on that, Senator Rob Portman of Ohio and Senator Ben Cardin of Maryland, have worked together collaboratively on this retirement space really for decades. And it was the 2 of them as House members who really were the inspiration for what became the Pension Protection Act of 2006. Now the 2 are in the Senate, and they want to do a Portman-Cardin 2.0. And they have introduced legislation on this. It's S 1431. Much like Secure, it's geared towards enhanced savings for IRAs and DC-type accounts. But like they did in the 2006 bill, I think there will be room for other changes. So we're going to pay close attention to what Senators Portman and Cardin are up to and work very closely with those offices. You had mentioned earlier, Hank, the Taft-Hartley bills and the multi-employer pension issue, which as probably most of the viewers know, it really is, it's a crisis for 10% of the multi-employer plans, but that is a tremendous amount of retirees and workers. And even that 10% is something that has to be focused on. There was a proposal. I don't believe it was introduced in legislative language, but Senate Health Committee Chairman Lamar Alexander of Tennessee and Finance Committee Chairman Chuck Grassley from Iowa kind of unveiled a proposal. The one thing that caught my attention, and we've talked about it, is the fact that they placed a cap on the discount rates that can be used for these multi-employer plans. If you go through the formula, it would be about a 5% cap using today's guidelines. There's been, at least rhetorically, among House Republicans, a linkage between capping multi-employer pension plan discount rates and capping governmental plans, state and local governmental plans. So this poses, of course, a big concern to us, and it's something that we have to pay close attention to. I mean, for years we fought against PEPTA, which was a mere reporting requirement based on a lower discount rate, a very low discount rate. But this would be a federally imposed cap. And as Bridget knows, what that will do, if you drive down the rate of investment return, the money has to be made up elsewhere, and it's going to come to the employer and the employees to fill that gap, and in a very politically volatile environment.
So before we turn it, or I ask Bridget some additional follow-up questions regarding 2020, I do want to encourage our audience to submit questions. So again, if you have questions or comments for the panelists, please submit them by using the GoToMeetings portal. So Bridget, certainly want to hear additional outlook for 2020, but also, as I think some of our audience members are aware, you and I and others, we've been having some conversations over the last year, 18 months with the John and Arnold Foundation, now known as Arnold Ventures. Some thoughts about how you see them and where that relationship has been, where it is now, and where it might be going in 2020.
Yeah, so it's not every day somebody who is so engaged in the pension space on a very specific side of it takes a step back and reflects. And that's what we've seen happen over the past year and a half with Arnold Ventures. And so I think what we're seeing is somebody who's coming to the table with the intention of trying to find solutions that hit on, I think, all of the things that we all share the same concerns about. Making sure that public financing is bigger than just this one little issue of pensions, making sure that we're not passing on significant intergenerational debt to future generations, making sure that our public employees, though, are able to have a secure and dignified retirement, and that systems are able to manage that and make that happen. And so it's been very promising what they have started to lay the groundwork for and what may come of it. I think particularly data-driven wise, I think that there's been a concerted effort to invest in organizations that will demonstrate what works and what doesn't work, where we can really take a look and see over the course of time, has this plan design change really fixed the intended problem that was outlined? And so I think just thinking that through, and also the fact that we have been brought to the table too often, membership associations, systems are sort of left figuring out what a piece of legislation needs to look like once it's implemented, rather than being brought to the table ahead of time. And I think that's really important to continue on.
Okay. And then at the beginning, you mentioned Colorado. What's going on there?
So, Colorado is an example of, I think, this recent theme that I think has emerged around risk sharing, which is a interesting way in which to approach plan design. And I think what I would caution about this risk sharing type style of making changes is, let's make sure we're really encompassing all the different potential outlooks of what could happen. So SB 200 at the end of the session in 2018 passed, where it included a auto click, an auto increase in the contribution if the investments saw a drop in returns. I think everybody saw in 2018 a significant drop in returns, thus triggering an increased contribution by employees. Well, 2019 was a very different story. The market recovered. There's no check in place for the employee contributions to revert back. So they'll continue to see that increased contribution even though the investments recovered. So how are we thinking those different potential increasing pieces for employees who are public sector employees, making maybe a reduced salary than they would in the private sector. How are we making sure that we're not penalizing them when we could look at investments maybe over a 3-year return or a 5-year return, something like that?
Okay. Great. Tony, so then going back to the federal side, what are the issues that attendees to the legislative conference may be advocating for in just over 2 weeks?
Sure. Yeah. Well, I'll mention one more tax issue.
Sure.
And then we can talk a little bit about a few non-tax issues. But under the Internal Revenue Code currently, there is an exclusion from income for retirees, first responder retirees, if the monies go directly from the retirement plan to the health insurance provider. That is a $3,000 annual cap on the exclusion.
Popularly known as the HELPS
Yes,
provision.
the HELPS provision. And there's legislation introduced which NCPERS fully supports, which would double the $3,000 to $6,000. A very nice change, given that the $3,000 has been in place since 2006, back to the Pension Protection Act. There's also discussions about this direct payment requirement and as to whether this is too cumbersome on plans. A number of plans find this to be a real problem when there are multiple insurance providers to be paid. Mm-hmm. It works great when your retiree health plan is sponsored by the municipality and there is one provider. The other provisions I'll mention is, well, one is brand new, and that is introduced by Congressman Tom Malinowski of New Jersey, who is going to be speaking at the conference, Senator Sherrod Brown of Ohio, and it would be a buy-in, optional buy-in to Medicare for retired first responders who are age 50. As we know, first responders retire earlier than other employees because of the rigors of their jobs, and they have a significant gap of time usually between retirement and the Medicare trigger age of eligibility age of 65. So this is a very important provision. Right now, it's kind of wrapped up in the Medicare for All debate. So it's very complicated right now. I feel like once we get through the election season, we can kind of diverge from that. And I think we have a piece of legislation that will have bipartisan support. Windfall elimination provision has been on the books since the 80s. It's a Social Security penalty if you also earn a non-covered benefit. WEP is the acronym. Numerous pieces of legislation have been introduced to both repeal WEP and reform it, including one recent bill by the chairman of the Ways and Means Committee, Richie Neal. And then the final issue I'll talk about, which I don't think the members will really get into, but it's worth noting, is infrastructure. And we've been in conversations with Congressman John Yarmouth of Kentucky about a legislative proposal that he's working on, which would be to create basically a $300 billion infrastructure bank at the Treasury Department. It would be funded through 40-year bonds, and these bonds can only be purchased by pension plans, both ERISA-covered plans and state and local governmental plans. So it's a very interesting proposal. If it comes to any fruition, it will be of great interest to our members because there would be a 200 basis point increase for the bond yield over the 30-year Treasury. So it looks like a very attractive investment. I'm not in the investment community, but it would seem that this would get a significant amount of attention. But infrastructure, I think, for this year, unless the president has a tremendous change of heart, which is always possible on any given day, it looks like infrastructure legislation's backburnered until after the elections.
Okay. So, Bridget, Tony alluded to it, but it's all in our collective consciousness, the 2020 election in November. How do you see that impacting the work that's going to be done in 2020? And how do you see the states and the politics at the state level relative to the election?
Yeah, so I think what this year creates is, in some states, a sort of wanting to back away and not drive through big pension changes because folks are jockeying for position, trying to curry votes amongst both, I think, membership organizations as well as the general public. There may be some states, though, that would prefer to use driving through pension changes as a way to gin up their base. I think the concern, right now for us would be Arizona. I think there's a lot of the more conservative leaning organizations that are really trying to make this happen, and they have majorities in the chambers. And so the other thing, though, that this creates is an opportunity for education. There's a lot of people now who are going to start coming out and wanting to lay out their platforms for what they want to see, their vision if elected, and how do pensions, how does retirement fit into that vision, especially in their overall public finance policy portfolio. I think it's really hard to support a candidate who may say we need to do plan design changes, but tax abatement and corporate subsidies are fine because they're economic drivers. The math's not there. So it's also really incumbent upon organizations that are impacted by legislators coming in to start laying the groundwork for what that good policy looks like. Because folks come in and for some reason know and understand how bond ratings impact public finance, but then don't always come in with the same level of understanding when it comes to how pension systems work. And so it's on us to make sure we're delivering our message now.
Yep, agreed. Tony, what does the congressional calendar look like given the election, and to what degree can we really anticipate some of the legislation that you highlighted actually moving through the legislative process?
Someone in my firm, and this is non-sourced, I don't want to give a name or say that it's accurate, but it sounds accurate, said that they went through the calendar and they looked at the legislative days in the House, and they looked at the full calendar, a 12-month calendar, and they said that the House would be in session for 8 days every month. Now, that is not the kind of, shoulder to the grindstone pace that one might think would yield a whole lot of productivity. But it is an election year. Congress is going to be out for large blocks of time, including the entire month of October and probably a significant amount of September. I would say that looking at the landscape, the multi-employer bill probably has the kind of political connections between the parties and in very important political states that the multi-employer bill could get over the hurdle and make it into law. Before the election, after the election, I'm not sure. It could be that most legislation is held until after the election and worked on in late November and in December. Some of the other items I mentioned are smaller. For instance, the changes to the HELPS exclusion, I think, needs a larger piece of legislation to ride along. Maybe that's Portman-Cardin 2.0, and that's probably not a this year bill. I do think there could be some movement on WEP. I think Chairman Neal at the Ways and Means Committee would like to get that off the dime, and it really has been stalled for a long time. So there could be some movement around WEP, and I think that's probably all we'll see, but I'm always, ready for surprises.
So in terms of WEP, do you think it would move as its own bill, or would there be an appetite for a larger Social Security bill?
in probably the earlier part of the Congress, so earlier last year, I thought there might be an appetite for this larger Social Security bill, but I don't think so now, because the only way to do Social Security reform is to increase the FICA tax. Yeah. And at some point there probably will be a bipartisan holding of the hands to do that, but I don't think we're there yet. So I do think WEP will have to go separately, at least initially, because then as we saw at the end of this year, things get merged with the bill that's going to actually make it to the president, whether that's a funding bill or probably in this case it would be an appropriations or funding bill.
So Bridget, going back to NPPC, I think most people in the audience know the structure that NPPC is set up to be a facilitator, effectively, of creating coalitions at the state level. So in 2020, which states do you think are going to have coalitions? And to the extent that retirement systems want to work with these coalitions, what's the best way that they can work together?
Great. So forgive me for any of the states I may miss, but off the top of my head, I know we are in Arizona, Colorado, Connecticut, Kansas, Kentucky, Louisiana, Oklahoma, Texas, Wyoming, Iowa, and Missouri.
Okay.
So some coalitions have been around for several years, and we have coordinators in place that help lead the work of the state coalitions. And we, nationally, I'm always happy to connect any systems that would like to connect and have those conversations with those people on the ground, especially if we have a strong table that can facilitate those conversations. In other states, though, always happy to pull those conversations together as well. These are important conversations to have, especially since I think the membership organizations that tend to make up the tables and the systems are the sort of only uniform historical groups that know what's happened in the years before and can help educate folks going forward that may be involved in policy-making decisions. So,
and then from the state coalition side, what are the roles that systems can provide? I mean, as you know, systems generally can't really lobby for a particular position, but still, they can be very supportive. What are the things that your coalition members would want from a state system or state or local system?
Yeah, I think trying to ensure that the systems are marketing, and I use marketing in like the broadest sense of the term, marketing themselves in the best way possible. I think there is a lot of really good work the systems do that legislators, policymakers, or the general public don't always know. So, for instance, right now, a lot of the conservative opponents in Arizona are trying to use the unfunded liability to really drag ASRS through the dirt. They're trying to say that bad investment returns have really damaged the system. And I was reading their annual report recently, and they have a chart in there that talks about their 1, 3, 5, and 9 year averages that paint a completely different picture. And so how are we countering that messaging, and how can systems counter that message as well? Another example is, I think, what hasn't been as much of a conversation this past year or into this year, but can always come up, is stress testing. I think if systems don't, if systems start hearing this message come out that there needs to be more stress testing, those CAFR reports, the reports that systems do regularly, need to make sure that those reports are in front of everyone, because it really infers that the systems aren't doing something they clearly already do.
Yeah, no, I think those are great points. Tony, we have a question regarding the WEP, and it's, I guess, asking specifically about the type of reform. Is it some sort, what are the ranges of reforms and what are the most likely outcomes?
And there is a range. From full repeal, legislation's been introduced in the House and the Senate to do away with both WEP and the government pension offset. So there's full repeal. There is legislation introduced separately by the chairman of the Ways and Means Committee and the ranking Republican, so that's Richie Neal, Kevin Brady, which would provide what they call a rebate, which would be a monthly reduction of your WEP penalty. The Neal bill is more generous at $150 per month. The Brady bill's at $100, but there's also $50 in the Brady bill for a spouse, if applicable. There are other bills out there, but that's kind of the main range. So when I say I think there'll be movement, I think there'll be movement on Chairman Neal's bill because he is the chairman of the committee, and no doubt he is enamored of his bill. I will say, however, that a number of organizations are working very hard at getting co-sponsors on the repeal bills. And those numbers are looking very high at this point. I mean, enough to get the attention, I think, of the leadership. For years, I have thought full repeal was not possible. And then Congress repealed the Cadillac tax. And I thought, well, and couple that with the fact there seems to be less interest in what the federal deficit is. Yeah. Less and less interest on both parties' account. So I'm beginning to think if there is a strong enough push for full repeal that it could be viable. So I would not dissuade anyone out there who's aggressively pushing for full repeal not to do that. But I do think initially here we'll probably see some action on the Neal bill.
Okay. So we're almost running out of time, and why don't we end sort of on a fun note. Let me get your prognostications about the 2020 federal elections in terms of the Senate chamber, the House chamber, and the presidency. Tony, I'll start with you.
Start with me.
Start with you. Do you think the Democrats will hold the House?
I do. I think the Democrats will hold the House. I don't see the Republicans making or gaining back those suburban votes.
Do you think the Republicans will hold the Senate?
Yes. And yes. Because I do believe President Trump will be at least competitive. I'm not saying he'll win re-election. Mm-hmm. I know you want me to say that, but I'm not going to say either way. But he will be competitive enough in key states that I think he probably gets enough of the Senate Republicans over the bump. But it'll be a Senate that's still, very much in the low 50s, yeah. Either way. Yeah. Either way.
And then on the presidential election, let's just do, who do you think is going to be the nominee for the Democratic side?
Right. I think Joe.
Oh, you know what? Think about that. Yeah, there's 6 of them. So let me turn to Bridget. House.
House, Dems keep.
Senate.
I think it's a toss-up. I think there's a way to it. And I think, again, not to put in a plug for what we do, but, when you look at the polls, the things that rank the highest, healthcare, the economy, and retirement. Yeah. So if we're talking, about retirement more, and we want pro-retirement candidates to win, we need to lay that groundwork now and have those conversations. Okay. I think that and then I already know my answer to the nominee question, which is, if you're looking at who is going to pull the, white working class voters and their wives, white working middle class male voters and their wives away from Trump, I think that candidate's Biden right now.
Okay. And then before I turn to Tony for his thoughts, at the state level, what should we look for in terms of like elections? You know, whether it's the governorships or the legislatures. So
I think what I will go back to 2018 and what we saw in Texas, which was a strong top of the ticket really can help pull things for folks down ballot. So Beto, though he didn't win, really helped, I think, pull Democrats across the finish line in key areas. And so I think that is the biggest consideration looking at what will happen in 2020, who those top of the ticket those top of the ticket candidates are.
Okay. All right, so Tony, you've had a little chance to think. On the Democratic side, who do you think the nominee is going to be?
I think it'll be Biden. I think and a lot of the reasons that Bridget just talked about, I think he's going to be the most competitive candidate. And I think there's going to have to be, in the Democratic primaries, caucuses, that realization. I think it's starting to sink in, and the field is winnowing, and I think he poses the most significant threat to President Trump's re-election. But Hank, what do you think?
I haven't had time to think about that. But what we will do is when we do our January webcast, we will revisit our selections and refine them.
Sure.
And then at that time, I will give you my answer. Right. So thank you all for tuning in. What I want to stress at the end is for those of you who want to continue this dialogue and see our panelists once again, please join us on January 26th through the 28th as we host our annual legislative conference. Both Tony and Bridget will be presenting, as well as other speakers, members from the House, from Congress, and from the administration will be there. So thank you so much for joining us, and I want to thank Bridget and Tony for joining us once again, and we look forward to doing this again in July.
Thank you.
Thank you.
Thank you.
Thanks.
Thank you.